Hello everyone, welcome back to our part 2 of discussion of chapter 4. We're still looking at deductions for AGI as listed on schedule 1 of the 1040. So the next one we want to talk about is self-employment tax. This is charged to those who have their own business, and we'll talk more in detail about what goes on that Schedule C or other form of business in Chapter 6. But for now, so we can talk about this, we need to give you the basics of how this works out. So first of all, you calculate net earnings from self-employment by taking business revenues minus business expenses, and then multiplying it by 0.9235. That's the same as deducting the half part of the self-employment tax that your employer pays for a regular employee. So you're familiar with this tax, referred to as FICA or something, on your, as an employee, it's withheld by your employer. What you may not realize if you're not in payroll is your employer pays the other half. You pay half of it, the employer pays half. Well, as a self-employed individual, you had to pay both, but it didn't seem quite fair to do it on all your income. So we multiply it by 0.9235, then by 15.3% to get the net earnings, the self-employment tax. There's a whole form for this to help us with the process, Form SE, okay, and file with the 1040. There is a separate video on how to calculate the self-employment tax with some examples in more detail, using some old numbers, but it gives you the same process as it would be in 2021. So remember, you calculate your self-employment tax based on net earnings from self-employment. You get to only deduct half of the self-employment tax for AGI. Okay? So the other half, you might say, is deducted when you multiply by 0.9235. So it does end up being fairly fair, but only one half is actually listed on the Schedule 1 of the Form 1040. Speaking of self-employed individuals, there is also a deduction for AGI for your health insurance. If you have no other health insurance with an employer, then you may be able to deduct the amount you pay for health insurance for you or your family as a 4AGI deduction. Limits: you cannot have more as health insurance deduction as you do income from the business that you pay it from. Okay, so it can't be higher than that. So if your business doesn't do well, that's going to be a problem in limiting your ability to deduct the self-employment health insurance. If you can participate at a job, because a lot of people have a job and they have a side business, if you are eligible for insurance at your your employment, then you don't get to take, even if you choose not to. If you're eligible, you can't. If you decline coverage at your employer and buy it on your own, it still doesn't qualify as self-employment health insurance. And you have to look at that on a monthly basis for the year. So if you were eligible because you worked someplace for 7 months, and then you weren't because you lost your job or something like that, you could only have self-employment insurance deduction for the 5 months that you didn't have another alternative. And this applies to your spouse as well. Important. If you take money out early from a CD, you're going to be charged a penalty. That is deductible. It's usually a very small amount. It's not going to be a big deal. It'll get reported to you so you won't forget, but you need to put it on your tax return you can deduct that. Since you got interest, right, that would be reported on the 1099 INT, so will the penalty. I've been doing taxes for years. I can't think of a single time where this was actually an issue. Alimony, however, is a much more common scenario that is on the Schedule 1. Now, you'll note that if you went back to the Schedule 1 part, it will actually ask for a Social Security number of the spouse paying it, or you're paying it to. So, and the date. Because the law now says that if you have alimony that's determined after December 31st, 2018, basically 2019 and forward, it isn't deductible for AGI. So this only applies to divorce agreements that happened prior to December 31st, 2018. Now, there's still an awful lot of divorce agreements that are out there, so this is still a very common thing. But you have to know, okay, what date is before you can't assume that alimony is deductible for AGI. And it can't have changed enough. So if maybe they had an agreement in 2016, but they did a major rewrite in 2019, that could disqualify it going forward, okay? So it has to, if you substantially modify it, and that's kind of a judgment call, then it will count as if it was a new agreement and therefore not be eligible for this deduction. So alimony is money between two divorced or separated individuals, okay? Typically, there are different amounts transfer between the two. Alimony, child support, and property settlement, okay? Only alimony previous to 2019 has a tax implication. We already talked about child support is not deductible to the payer and not income to the receiver. If alimony is deductible for one spouse that pays it under the rules, then it's included in income for the one that's receiving it. That's why they want to know the Social Security number, so they can check to see that the receiving spouse is reporting the income, just like the one that's paying it is deducting it. Property settlements also do not constitute income to the receiver. Now, property settlements is usually a transfer of some kind of asset at divorce. So if we divide up, say, the house, and we say, okay, well, we owned it jointly before, but really only one of them is going to live in it. And so the one that's not going to live in it transfers their part of the house to the other one. That's a property settlement. That's just a matter of dividing up the property. That is not income to the spouse. It's not alimony to the spouse. All right? Doesn't qualify. To qualify as alimony, we are fairly specific. Payment must be in cash. Okay? No in-kind alimony. Must be required according to the agreement. I know this sounds a little weird, but if a spouse paid more than they were required to by the agreement to the ex-spouse, that would not be, the part that they paid over and above what was required is not alimony. All right, so that would not be deductible for AGI. So that's how that actually works out. And the payments have to end with the payee spouse's death. And that's kind of a weird one there, but it has to end at the pay. So I'm making alimony payments at the point that my ex-spouse passes away. I no longer have to make those payments. Okay? If it doesn't, if there's no mention of that, then it's not alimony. So if I have an agreement to pay the mortgage on the house, even though I don't live in it, for my ex-spouse, if it is a 15-year mortgage, I could pay it past my spouse's death, and therefore it would not be alimony. There has to be that condition that it ends at the death. Now, the other kind of caveat or special circumstances is if the alimony starts off high right after the divorce and it goes down low after a year or two. And the problem with that is that looks like or feels like, and the tax law treats it as if it is a property settlement. It just happens to be, instead of giving pieces of assets, it does it in cash, and therefore it's not alimony. And that's the idea of, it feels like, it looks like a property settlement, not alimony. And so we have rules that will say, if you do that, if your alimony drops like more than $25,000 between year 1 and year 2, or year 2 and year 3, then the part that it goes down like that is going to be considered a property settlement from year 1, and you're going to have to go back and treat it as a property settlement, refile your return, and take it off as alimony and put it on as, well, and leave it off, because the property settlement wouldn't be part of your tax return anyway. The last one of these 4 AGI deductions, these valuable deductions, is for educator expenses. This is valuable because it's 4 AGI, but it's not very valuable because it's only $250. All right? If you're married filing jointly, you can both qualify $500. But you can't do more than $250 of your own expenses, so both of them got to spend it. Okay, it can't be just, together we spent $500. So, who is an eligible educator? Who qualifies? All right, again, this is fairly narrow, but there are still lots of people who qualify. So this is a pretty big group. Teacher, instructor, counselor, principal, K through 12. So as an instructor at college, I don't qualify. Okay, it's got to be at least 900 hours, can't be part-time. 900 hours is about half-time for the year, so it's got to be more than half-time to do that job. Okay, and you usually can do that 900 during the school year. Okay, but the expenses are paid during the calendar year. Again, not a whole lot of money involved, so not that big of a deal, but you're going to have evidence that you spent this money if you want to take that deduction and get challenged on it. What you spend it on. Qualified education. The idea is we're helping out teachers who feel a need to buy things for their classroom because the school is not providing all the supplies they need in the classroom. And therefore, they're putting out money of their own pocket, and that should be deductible. Okay? And so that was expanded during the pandemic to include for personal protective equipment or disinfectant for the classroom. I think for the most part schools were covering that cost, but if not, then the educator could deduct the amount of money they spent on that. Again, maximum $250. Okay.